S&P is still fighting for that 60-50 as we head into the last 10 minutes. Liz Ann Sonders joins me alongside Collin Martin for big picture discussion. Liz Ann's chief investment strategist. Collin's director of fixed income strategist. Great to see you both this afternoon. Thanks for coming on.
Hi,
and good to see you guys, of course, in SF. That was fun. Good catching up in person. Liz Ann, as we've got stocks seemingly in pretty decent shape, it seems like we're just kind of trading off days. Some days big tech, some days the rotation. Seems to be working pretty well for us.
It is. You got two of the growth trio, as we call it, up today with comm services and tech, financials down on the bottom. I think a lot of these really fierce sector rotations from a day-to-day basis don't always have something you can immediately point a finger to define it. I think that's just the nature of the beast these days. You do have a little bit of a move up in longer term yields. The yield spread, at least 10s, 2s, is still in positive territory. So that can have some influences in the short term. But as we've talked about before, Oliver, I think these fierce sector rotations are likely to continue. And I think as we head into 2025, we continue to think factor oriented performance will be a bit more consistent than sector performance.
Okay. And quality still the message, Liz Ann?
Quality is still the message, but I think one shift, not that the market thinks in calendar year terms precisely, but that's what we all do when we start writing our outlooks, is I think there's going to be a shift from level to change. What I mean by that is, strong versus weak was sort of ruled the day last year from a factor perspective, whether it was balance sheet related, cash flow related, interest coverage related. Now I think because there's a lot of money looking for opportunities down the cap spectrum, maybe even down the quality spectrum a bit, I think you want to look for the strongest rate of change improvement in many of those factors to sort of catch the turn, not just focus on level.
Yeah, I like that. All right, let's talk levels versus change for bonds, Collin. A kind of small magnitude move today for bonds, but intraday swing, that change pretty decent after JOLTS. What do you make of that reaction?
Yeah, I think there's a few things that are driving Treasury yields. We saw them down pretty sharply early in the morning, I think most likely due to the news from South Korea. And then the move up, I think, is twofold. One is JOLTS, which I think had something for everyone. If you look at the data, you can find arguments really for either a stronger or weaker labor market, but I think it did tilt more towards the stronger side. One thing that really sticks out and something that we focus on a lot is the quits rate. I think if you look at what the overall quits rate is, that kind of signals that workers are confident in getting a potentially better job somewhere else, so they already have that coming. So that moved up to 2.1%, the highest reading since May. So that was strong there. And then the number of job openings in and of itself were a little bit better than expected. So I think that was part of the move. But then as tensions kind of died down a little bit in South Korea, I think that was a second move higher, or a second driver of the move higher in Treasury yields. One third factor, which didn't make as many headlines, could be the idea that there's not much Treasury supply right now, but there's been a lot of corporate bond supply. And when people are going to buy corporate bonds, sometimes they have to sell something to buy those. And we're seeing this huge wave of new issuance following last week's holiday week with corporations. They're taking advantage of really, really strong financing conditions. Yes, absolute yields are high, but relative yields are low. So corporations really don't need to pay up much to issue debt today. Okay.
Good point there. And did see that as well. For the blanking on the retail deal that got blocked. Okay, so people are going to want to tap the market, and I do wonder kind of the year-end kind of window dressing, if you will, what kind of role bonds are going to play in that, and especially the relation to stocks and where folks get their income, Liz Ann, because right now you've got a decent 4%. I feel like people are still somewhat happy to get that, but then when you get data like this morning, you start to wonder, if those cuts are ever going to come. What do you think, Liz Ann?
Well, it's not just cuts of the Fed funds rate, of course. What happens to the rest of the yield curve? We did see a big move up in the 10-year alongside the start of an easing cycle, and that tends to matter more in terms of both psychology and the tie-in to equities. I think in terms of that relationship between bond yields and equities, if you look at a rolling 1-year correlation, you're still in inverse territory between the 10-year yield and equities, but it has been moving more toward positive territory. And I think looking ahead, what ultimately will be the driver of moves in bond yields and how they influence stocks is the why behind the bond yield movement. I think if bond yields stay connected to the growth side of the equation, higher bond yields is not a negative necessarily for the equity market. But if yields become reconnected to any concerns on inflation, then I think higher bond yields would be negative for equities. So it's not just the what, but the why.
Totally. So today's JOLTS would be a good why, right?
Yeah, that clearly suggests tightness in the labor market, but that also could put some pressure on the Fed, particularly if we get a strong labor market report, to go into pause mode at the December meeting. That's not what the bets are now per the Fed funds futures market, but that certainly could change if we get a hot employment number on Friday.
Nice. All right. Bonds meet stocks. Perfect. Exactly what we needed. Thanks, guys.